finance fees, and then there is an operating lease.
There are internal auditors everywhere, then how did that Vijay Mallya fraud even happen?
Gross profit will give me the sales.
Are internal auditors as independent as external auditors?
Let's discuss now, after having discussed this about non-current assets, current assets, provisions, and all of that. I want us to focus on now events that take place after the reporting period. And to understand the standard better, let us first of all understand the concept of reporting date. Reporting date is the date for which the financial statements are prepared. So, when I say reporting date, it means the date for which the financial statements are prepared. So, if I have prepared a set of financial statements wherein the profit and loss account is for the year ended 31st of March 2024 and a balance sheet dated 31st of March 2024 has been prepared, then that 31st of March 2024 becomes my reporting date. 31st of March 2024 becomes my reporting date. Now, if I look at the cutoff date is 31st of March 2024. So, all the events that occur till 31st of March 2024 are included in the books of accounts. The transactions are recorded and they find their way and impact into the financial statements, which is basically your balance sheet, profit and loss account, your cash flow statement. Now, we specifically want to focus on those events which take place after the reporting date. So, events which take place after 31st of March, events which take place after 31st of March, and but it cannot extend into infinity, right? Not every event that takes place after 31st of March should be a matter of concern for you, because if you do that, that would potentially make your life miserable, because those are limitless transactions till the end of time. So we are covering all events which take place after 31st of March, but till the date of till a particular date. And what is that date? Which take place after 31st of March and till the date the financial statements are authorized for issue. Okay. So these are events which take place after the reporting date and till the date the financial statements are authorized for issue. I have not said the date the financial statements are signed. I am not saying the date the financial statements are audited. I am using a very specific term. I am saying till the financial statements are authorized for issue. And what do you mean by date till which the financial date on which the financial statements are authorized for issue? To understand that, let us get into the life cycle of a set of financial statements. My financial year runs from 1st of April 23 to 31st of March 24. This is my reporting date. Okay. Now, after the reporting date, there will be auditors who will come. You will present them with draft financial statements. Then the auditors will go through the financial statements, books of accounts. Then they will express an opinion. If there are misstatements, they will they will ask you to correct those misstatements. After the misstatements have been corrected, the financial statements will then be presented to the board. The board will adopt the financial statements, as in they will say yes to the financial statements, and the directors will sign first. The directors will sign first and then the auditor will sign later. See, the responsibility for preparation of financial statements is with the management of the company. So, the financial statements have to be adopted by the board, signed by the directors first, and then they are signed by the auditor. So, now, date the financial statements are authorized for issue What are these? The date the financial statements are authorized for issue is basically the date the board of directors adopts the financial statements and these are signed by director. So we are not talking about the date the financial statements are signed by the auditor. We are talking about the date when the board adopts the financial statements and the directors sign the financial statements. Okay, signed by the directors of the company. With this in mind, now we know that there is a very specific time frame that we are talking about. So this would be my year end. Say these are authorized on 30th of June and signed by auditor on, say, 13th of July. This time period is the one that is covered by IAS 10, not the time after 30th of June. Now, let's try to understand. Let us try to understand how should you deal with the events that take place after the balance sheet date but before the date the financial statements are authorized for issue. These are events which could take any form. It could it could be something as simple as the company announcing a major takeover, or the company's go down getting burnt and everything getting destroyed, or a debtor becoming bankrupt. It could be any of these. So I'm splitting all my post balance sheet date events into adjusting events, and the second category is basically non-adjusting event. Okay, adjusting and non-adjusting. Now, what are adjusting events? These events provide additional evidence of conditions existing at the reporting date. Okay, so they provide additional evidence of conditions existing at the balance sheet date. Now, what could be covered here? What do we mean by additional evidence of conditions existing at the balance sheet date? To begin with, let us assume that there is your financial year ends at 31st of March, and on 7th of April there is a fire in a particular godown of your company. And because of that fire, the entire godown is burnt. There is a lot of damage to inventory. Your entire building has been damaged. Now, the any conditions for that fire, any indicators for that fire did not exist on 31st of March. See, basic common sense. If these conditions would have existed, you would not have waited for 7th of April to dawn and for your factory to catch fire, right? What you would have done is, you would have taken all steps to prevent that fire. So for this particular event, the conditions did not exist on balance sheet day. But imagine a situation where you are valuing your inventory at cost or net realizable value, whichever is lower. You record it at cost because you do not have any evidence of net realizable value. You record it at 50. You record it at 50, and on 3rd of April, there is a sale of that particular item and it is sold for 48 rupees. So, what is the value you realized on the sale of that particular item? You realized only 48. Now, on 31st of March, there was no sale that took place, so you were not in a position to find out the net realizable value. But after the balance sheet date, when the sale of this particular item took place, it was sold at 48. And when it was sold at 48, you came to an understanding, you came to a conclusion that the NRV is 48. Now, if the NRV is 48 on 3rd of April, then and no other sale transaction has taken place between 31st of March and this date, then it is quite understandable that even on 31st of March, the net realizable value, had a sale occurred, would have still been 48, which means the accounting that you have done, the measurement that you have done, you have recorded this particular item, you have recorded this particular inventory at what value? You have recorded the inventory at cost. You have recorded the inventory at cost of 50. At the cost of 50. And what is number of units? There are 100 such units. So what is the cost? The cost is 5,000. Now on 31st of March, as I told you, no sale took place, so you are not in a position to calculate NRV. A sale took place on 2nd or 3rd of April for 48, which is my net realizable value, which is lower than this 50. Inventory was in your books of accounts on 31st of March. It was just that on that date, the sale did not take place. But if on 2nd of April, the sale has taken place at 48, it is enough indication for you to know that had the sale happened on 31st of March, it would have happened at 48. My principle in IAS 2 says cost or NRV, whichever is lower. Now 48 is the lower of cost versus NRV. And since 48 is the lower of cost versus NRV, I should actually be valuing it at NRV of 48. So, this event which took place after the balance sheet date provides enough information or provides additional evidence about conditions which existed on the balance sheet date. So, this requires an adjustment to your books of accounts, which is why I call it an adjusting event. What do I mean by adjustment to books of accounts? Right now, my inventory is at 50,000. We calculated this just now. Sorry, it is at 5,000, not 50,000. Okay. And I have found another item of inventory and it was sold for 48 rupees. The one that was valued at 50 per piece is now getting sold in the market at 48 per piece. This is my net realizable value, which has come to my notice after 31st of March, but which provides me enough information and additional evidence about conditions that existed on 31st of March. So I need to adjust, I need to record the impact of this in my financial statements. What I will have to do is, see, the inventory value has fallen down, which means I will have to record the fall in value of inventory. I will have to debit P&L account debit. This is fall in value to inventory by how much? By 200. By 200. Now this inventory which was appearing at 5,000 will now appear in the financial statements at 4,800. This was an adjusting event. It made me adjust the values in my financial statements by way of recording an entry. Okay. So these are adjusting events. They require an amendment to they need you to record an additional accounting entry or to rectify an entry that you have already recorded. They would require you to do this. Now, in your exam, instead of spending time on understanding and applying your logic, did conditions exist on the balance sheet date or did they not, I'm giving you a simpler way out. What you should do is, I'm giving you a list of all those events which are under the category of adjusting events. Make sure that you learn those, remember those. So when this question comes in the exam, you don't have to spend too much time thinking. You can finish it up quickly and then move on to the next question. Okay. So what all would be covered here? One of these examples would be bankruptcy of customer. See, the customer or the receivable was already appearing in your books of accounts on 31st of March. It was in existence on 31st of March. You got additional information about the bankruptcy of a customer, and a customer does not suddenly become bankrupt one fine day, right? If you got the news on 3rd of April, on 31st of March also, the conditions relating to his bankruptcy were already in existence, which is why this would come under the category of an adjusting event. Similarly, an item of inventory sold at a value lower than the cost after the balance sheet date would also come under this category. So, sale of inventory at a value lower than cost, and we saw how to adjust this particular entry. What is the how to adjust this particular value? What accounting entry should you record? Now the fire at your warehouse example that we took place, that is not an adjusting event because conditions did not exist on the balance sheet date. My common sense, as I told you, tells me if I knew this is going to happen, I would not have let it happen. Then receipt of information after the reporting date that indicates that an asset was impaired at the reporting date. Okay. So, receipt of info at reporting date which says asset was impaired at reporting date. This would also come under the category of an adjusting event. The settlement after the reporting date of a court case which confirms an year-end obligation. So, settlement after the reporting date, settlement after reporting date of a court case which confirms an year-end obligation. Which confirms an year-end obligation. So, what this means is, what is the situation? On 31st of March, there was a court case which was filed against you, and after 31st of March, information has come to your notice which confirms the fact that there is going to be an outflow of economic benefits from the entity. The court case was already filed against you before 31st of March. The events after 31st of March only gave you additional information about the fact that now the obligation has become probable. There are higher chances of you having to pay than you not having to pay. So this is connected with IAS 37 also. So this particular event would also come under the category of adjusting events. And one classic example is inability of a company to continue as a going concern. Inability of the company to continue as a going concern is also an adjusting event because it will change the entire basis of financial reporting. Under the going concern basis, the method of presenting the financial statements is different. If the company is not a going concern, then you have to present the financial statements on a breakup basis. So that is what is also, it also comes under the category of an adjusting event. Now, the second type of event that occurs after the balance sheet date is your non is a non-adjusting event. Now, what are these non-adjusting events? These are events which occur after the balance sheet date, but which do not concern conditions existing at the reporting date. So, they do not concern conditions existing at the reporting date. So these are those events which have nothing to do with what conditions existed on the balance sheet date. For example, if there is a fire that breaks into your factory, or there is a natural disaster which destroys a factory and a warehouse, the machinery is destroyed, the goods are destroyed, and it is complete. No amount is recoverable now. There is a major crisis or a major event that has taken place, but conditions did not exist on the balance sheet date. So for these non-adjusting events, don't adjust. The name itself says these are non-adjusting events. So I am telling you, don't adjust, disclose. Okay. Don't adjust, disclose. So these events that we are talking about, the users of the financial statements have to be aware of the existence of these events. They should know because it will impact their decision making. But do you need to make a change to the financial statements? No. You only need to let the users know by way of a disclosure note, and this helps you achieve that. Okay. Now, what could be examples of non-adjusting events? Announcing a plan to discontinue an operation. Okay. So, announcing a plan to discontinue operations. Okay. Then a major purchase of assets. You make a decision to purchase assets after the balance sheet date. See, the users of financial statements need to know that the income generating base, which is your asset base, is going to increase and how it will impact the future prospects of the company. But do you need to go back and make changes to the financial statements? The answer is no. Announcing a plan to discontinue operations is a futuristic scenario Do you need to go back and change the financial statements? The answer is no. Entering into significant commitments or contingent liabilities. Any contingent liabilities? Again, these are possible obligations. It is not a probable obligation. So the chance of this happening is less than the chance of this event not happening. So it will also go under a non-adjusting event. These are again required to be disclosed. You don't need to account for them. Declaration of dividend. Dividend declared is also an event that takes place after the balance sheet date, and commencing a court case after the reporting date. Commencing a court case after balance sheet date. These are all examples of non-adjusting events which require a disclosure, which do not require you to make changes to the financial statements. Now, the advice to you would be, as much as possible, see there are 5 to 6 events under both categories. Learn them. More or less similar events are asked in the exam. So that will help you to finish the question quickly and move on to the next question. After this, we will get into a discussion of different MCQs on this topic. And one important point, that a going concern crisis. Going concern crisis. So, what is the going concern concept in accounting? The going concern concept basically states that an entity is likely to continue its operations for reasonable foreseeable future. And how do you define reasonable foreseeable future? It is a period of 12 months from the reporting date. So if the company is unable to continue as a going concern after the reporting date, that is, there are no chances of the entity being able to continue its operations for 12 months, then that situation is a going concern crisis. And this is always an adjusting event, because now you will need to change the way the financial statements are prepared. The financial statements now have to be prepared on a breakup basis, which is a different way of presenting financial statements, where all the assets and liabilities are written down to their net realizable value, and then the entire approach changes. But that is also an adjusting event. After this, we'll solve MCQs related to this particular topic.